Welcome back to BrainBoost, where we break down the biggest global shifts with insight, data, and a dose of reality. Today we're diving into something that might seem boring at first, US Treasury bonds. But don't click away just yet. These aren't just pieces of paper collecting dust in vaults. They're powerful tools that affect inflation, interest rates, currency values, and even geopolitics. In particular, we'll focus on the two biggest foreign holders of these bonds, Japan and China. Why do they hold them? Why are they changing course? And what does it mean for the global economy, and for you? Let's start with Japan, a long-standing, loyal buyer of US Treasury bonds. Japan holds over $1.1 trillion in US debt, making it the largest foreign holder. But why? The answer lies in currency management and economic stability. When the yen weakens, Japan's central bank or major institutions might sell US bonds to buy back yen, supporting their currency. This is a classic foreign exchange intervention tactic, used to stabilize their export-driven economy. But that's not all. Japan is also dealing with ultra-low interest rates at home, even negative rates at times, while US Treasuries offer higher returns. So, investing in US bonds is attractive. It's a safer place to park capital, especially during global uncertainty. And because Japan and the US share deep economic and political ties, these holdings also serve as a trust-based financial bridge between the two economies. But remember, Japan's moves are usually short-term, tactical, and focused on keeping their financial system stable. Now let's talk about China, whose approach is very different. Over the past decade, China has been steadily reducing its US Treasury holdings. In 2010, they held over $1.3 trillion. Today, it's well below $800 billion. Why? Two big reasons. First, diversification. China is moving away from the dollar. They're buying gold, investing in euro and yuan-based assets, and pouring money into infrastructure projects across Africa, Asia, and Latin America through the Belt and Road Initiative. Second, geopolitical strategy. As tensions rise with the US over Taiwan, trade, and technology, China wants to reduce exposure to US sanctions or financial pressure. Diversifying their reserves is a way to protect their economic sovereignty. This isn't just a finance story, it's a long-term geopolitical game, where China is hedging against future instability in US relations. So, how do these moves impact the global economy? US Treasuries are considered the safest financial assets in the world. They're used as collateral by banks, held by governments, and influence everything from mortgage rates to currency values. When Japan or China buy bonds, it pushes US interest rates down, making it cheaper for the US government to borrow. When they sell, it has the opposite effect, potentially raising rates and creating market volatility. But here's the key. The US bond market is so massive, over $25 trillion, that even large moves from Japan or China don't crash it. Still, investors watch these moves closely because they signal bigger trends in global finance. Bond holdings are also a geopolitical tool. With Japan, the United States enjoys a strong military and economic alliance. Their bond relationship is based on stability and cooperation. But with China, it's more complex. In theory, China could use its bond holdings as leverage, dumping treasuries to hurt the United States economy. But in reality, that would hurt China too. It would devalue the bonds they still hold and cause market chaos, which could ricochet back into China's own economy. So it's a delicate balancing act. And that's why both countries manage their bond portfolios with caution and strategy. Looking ahead, we expect Japan to stay the course, managing its holdings to balance the yen and take advantage of US yields. China, on the other hand, will likely continue diversifying, moving toward multi-currency reserves and gold, and possibly increasing infrastructure-related investments abroad. For the US, this means maintaining the attractiveness of its bond market is more important than ever, especially as it faces rising debt, potential rate cuts, and ongoing global uncertainty. You might be thinking, okay, but how does this affect me? Well, a lot. If US bond demand drops, interest rates could go up. That means higher mortgage rates, credit card interest, and business loan costs. A weaker dollar or economic shocks from global shifts could raise import prices, leading to inflation. And if geopolitical tensions rise, markets could get choppy, hurting your investments or retirement savings. So, Understanding this bond game helps you understand how global decisions ripple into your daily life. The world of finance might seem far away, but it's shaping the world you live in, every day. So stay curious, stay informed, and stay with BrainBoost as we unpack the big stories behind the headlines. If this breakdown helped clarify the bond game between Japan, China, and the US, hit like, subscribe, and let us know your thoughts in the comments below. This was BrainBoost Context with Clarity. Thanks for watching.